to see you all here. And today we have some interesting topics to discuss with you guys. Let's first look at the things that we're going to cover here today. First of all, let's have a market overview. And we are currently observing a Wyckoff distribution pattern at play, and it's probably worth studying. We have to pay more attention to how the whales are distributing the tokens according to the Wyckoff scheme. We already mentioned how the Wyckoff scheme was played out in the previous episodes, and we are going to discuss the scheme later on. And then after that, we'll talk about the ETH 2.0 merge upgrade. Last episode, we told you guys that we are going to bring you some new updates about the ETH merge. And after that, we're going to cover some fundamental tokenomics analysis. It's very important in terms of investing in different types of tokens, because different projects have different tokenomics, and some of them might have some special characteristics, like maybe some of them are inflationary and some of them are deflationary, which will also affect their price movements in the long term. And we're going to cover these things in the later on section. And after that, we are going to look into some meme coins. Meme coins are, the gems of the crypto world. A lot of us, we all love meme coins because it's very interesting, also funny to participate in the community and see things going to the moon, and it's very funny. And we're going to talk about it later. And we'll also talk about some upgrades of some protocols that we think there are some upgrades which are useful, and also maybe they will bring some changes to their protocols, some upgrades, new demand, and also new functions, new utilities. And in the end of section, we're going to discuss how to avoid traps in terms of investing into different projects. We have to look at their tokenomics, and also their community background, and also the developer background, that kind of things. So without further ado, me, Johnny, and Dave, we are going to cover these interesting topics with you guys. So first of all, we are going to look at the current market. On the right hand side of this slide, we have the schematics of Wyckoff distribution, and let's look at the patterns first. I want you to look at the patterns, because what matters in Wyckoff distribution scheme is that we have to distinguish different phrases, because they mean different. They mean in fundamental terms, they mean different events. Different events have different characteristics. For example, when we have the first phrase, we have the buying climax, and we usually observe a change of character. For example, it actually illustrates or indicates that the trend is going to reverse. So let's look at Bitcoin chart first. Okay, so wait a minute, let me show you guys the chart here. Bitcoin chart. So right now it's trading at 23K. I'm a little bit worried that it's falling off the trend line that I drew from the low here, and all the way connecting the two lows, the two previous lows. Some people might think that it's actually a bear flag. Is likely to play out, because it just fell through the trend line here, and it's struggling along the trend line, and probably we're going to see some downward price development until the next trend line. The trend line here is really important to watch. And let's apply what we talk about in the Wyckoff. I'm a little bit worried that this thing here, we have a buying climax here. Remember what I talked about in the previous slide? This is the buying climax, and we could actually easily observe a change of character. What does it mean to have a change of character? So we have a really nice bullish uptrend here, right? And then it reaches the top of the trading range, like the previous high, and then we suddenly see a huge demand, a huge supply coming in, right? So it's a really significant candle to observe here. This candle actually tell us that the previous effort has been wiped off, right? So this candle actually indicates a change of character. So basically from uptrend to the big red candle here, consuming previous demand, and then we can tell that it's a change of character. So after a change of character, we are expecting the price to be trading within the trading range, right? According to the Wyckoff methodology. So we have some text here, secondary text, which tests the lower boundary of the trade. If this is a distribution scheme to be played out, and then we are expecting price to trading very close or trading below the trading range, right? So at the bottom of the trading range, we're going to see prices are concentrating at these lower boundaries. And after that, we have a upthrust here. This phrase actually tells us that to test the demand in the market to see if people are still being bullish. And we can see that the volume here, the volume is actually important here. The volume here, we don't see a lot of buying volume. Actually, the volume is kind of small, right? Because if we compare the volume here to the volume in the previous buying climax, it's actually very, very different. It signifies a contrast here. There's a contradiction, right? A lower volume signifies less buying pressure. And after that, we see supply stepping in. The series of supplies is here. We see a lot of supply stepping in here, pressing down the prices, and the same theory, right? It's actually ending the previous uptrend. And here we're expecting that prices go lower, because if prices go lower with a high volume, right, you can see that the volume is actually higher than the buying uptrend here. So it's actually telling us that supply is dominant here. What we can actually learn from the chart and also from the Wyckoff methodology is that with greater volume in selling, we are seeing a dominance in supply, and as a result, we can see the price keep going down, and then after that, this phrase is really important. The reason why this phrase is important is that market makers have to, after they confirm that supply is dominant and demand is weak, and then they have to build their shorts at higher positions so that they can benefit later on, right? And that's why they have to push up the prices back to top of trading range, right here. And then some important characteristics I want to discuss here is that this red big downward candle, this one is really important. It's actually the same as the previous one. You can see that we can very it's very easy to observe and to identify in a chart. We first of all, we look at the biggest candle in the chart because they signify the trend, the direction of the trend. And this red candle, big red candle, and also this big red candle actually tell us that supply is dominant. And also we have an downward wick here. The wick actually also carries a message. It actually tells us that any prices trading above this area, above 25K, was rejected. So we learn from the wick that the prices above 25K was actually rejected and followed by some very strong downward movement. The follow through we see here actually tells us about as actually the phrase D. That's actually the upward, the upthrust after distribution. So actually, we are seeing a lot of distribution here, and this thing is actually signifies the end of the top of the Wyckoff distribution scheme. And what is interesting is I want to put a closer look at the time frame here. This one, I want to show you guys. We are also seeing a very similar, interesting pattern here, a smaller version of the Wyckoff. You see here, a smaller version, a smaller time frame, Wyckoff distribution here. So they pulled a Wyckoff distribution at the upthrust after distribution. It's really interesting to see, right? So first of all, if I buying climax here, we can also very easy to observe that there's a change of character here, signify the end of the upward trend, right? Especially this wick here, and then the distribute here, right? Tokens are Bitcoin that's being distributed here, trading at a low, the neckline, I would say here, and then they push up the price to liquidate shorts, early shorts, because a lot of people actually they think that after seeing the price rejection, the end of the upward trend, and then they are going to short, right? They think price is going down, and then they put some shorts there, and then this upward movement is to liquidate other competitors in the market, liquidate other shorts, and also for the market makers and also for smart money who identify this Wyckoff distribution to play some very nice shorts here. They build a short position here, and also for them to acquire liquidity here, because when you push up the price, people are going to FOMO, and then that's where they can sell and execute the short positions with some very good liquidity here. So after that, price gone down, right? And we are seeing the upward price movement signifying the upwards after distribution. It's really interesting to see another Wyckoff distribution being played out here. So it broke out of the trend line, and we are expecting, further downward price movement, Not financial advice though, it's just my opinion towards how this is going to play out. I don't, doesn't mean that you have to. I'm not telling you to trade. I'm just sharing my opinion. Let's see how it plays out, right? As for ETH, same thing. I'm a little bit suspicious that it's playing a larger scale of Wyckoff distribution scheme, because we can see here same thing, right? I already explained buying climax, and also some secondary tests at the lower boundary. The lag line is here. After that, upthrust after distribution is here. It's very interesting. And also, I want to talk about this area, right? Let's pull it here. Oh, sorry. Here. Let's look at here. It's actually another Wyckoff. You see a very nice little neckline set up here. Buying climax, upthrust, secondary test here, and the upthrust after distribution. It signifies we always want to see that the wick here is very, very important, because the wick tells us that it's actually the upthrust after distribution, and actually you can play some short position here, and then we can do some short covering after it broke the downward trend, and then we use other indicators like momentum indicator, MACD, and RSI for us to determine whether price demand stepped in, and then we end our short, we cover our short here. So basically a very typical Wyckoff distribution scheme being played out here, and then another bigger scheme here, an upward ascending Wyckoff distribution pattern here. This thing, upward after distribution, upthrust after distribution, right? And we are also seeing the wick here. We don't see the wick here because we're looking in the 1 hour time frame, right? If we look at 4 hour time frame, it's going to be a wick, right? A big wick here. The wick actually, I already explained, right? The wick actually tell us the same thing as a wick here. It tells us that the upthrust after distribution, yeah, it signifies the phrase of the upthrust after distribution. So you better remember this wick. It's really important. And also the big candle here. We look at the biggest candle in the chart to know and to realize the behavior of market participants. Bullish, bearish, right? The wick is really important here. We're expecting to see if this holds, if the neckline here holds, if the support here holds, and then maybe they will, who knows, right? Maybe they are accumulating again somewhere here. But the likelihood of this neckline being broken is, in my opinion, is actually quite large, right? Quite high, the probability. So if it breaks the neckline, also trend line here, it actually signifies the end of the upthrust after distribution. So basically, they done their distribution all the way here, and then they are going to mark down the price. They are going to dump into the price, so that they can take profits from their short position they acquired here, right? What they do, they push up the price, they get some very nice liquidity here to build the short positions, and then they mark down the price. That's what they do in the Wyckoff distribution scheme. So yeah, same thing as Dogecoin, same thing. Very nice setup. Buying climax, upthrust, secondary test, upthrust after distribution. Again, we will look at the wick, the fake pump here. If you look at 30-minute chart, the wick will be more, easy to observe. It's very easy to observe here, the wick here. And then we're seeing a lot of big red candle consuming the previous demand. And one thing I want to, I want to talk about is that in the Wyckoff distribution scheme, or whether it's distribution or accumulation, will also tend to analyze the time frame, the scale of this setup. So basically, if this setup is taking a longer time, so basically Wyckoff has one rule that is cause and effect, and also the effort. So basically what they do here is the effort. If they have a longer time frame, if they have a longer time distribute their coins, and then the effect is going to be bigger, right? So we're expecting more downward selling pressure here. So basically, this is a, just my opinion towards the current market. And by the way, let's move on to other interesting topics that Dave is going to discuss with me and also you guys. So Dave, today we are going to, analyze some fundamentals of tokenomics. And yeah, maybe you can start. Let's talk about this, Dave.
Cool. So I think tokenomics is kind of like a very hard or sort of like a very popular topic that people talk about all the time, to analyze somebody or some tokens on your fundamental side. And I think the first thing people have ever thought of is like either the team or is the protocol itself or the tokenomics. So I think there are like 8 perspectives of analyzing tokenomics. The first is to talk about initial supply, like what's the team holding, how much is on the market, is there a limit or maximum supply, which is second perspective. And on the third part is with the vesting period or vesting time, how many tokens are being coming out to the market, and then they are contributing to the net inflation rate, and how many vesting pools, how many whales are vesting their tokens across
Some
time
audience
frame.
is saying, hey Dave, 1 minute, okay,
What
sorry
what
to disturb you. Some audience is saying that this is actually a recorded video, and it's not. Actually, I'm just sharing my screen. That's why you are seeing, some maybe green thing here. But it's funny, right? Let's look at the chart, right? Let's look at the chart.
No, I'm
It's
bored,
actually
bro.
real time. It's actually real time,
I'm
like
bored.
235 98. It's actually real time. Now, don't worry about it. It's not a recorded video. We are actually real time analyzing Bitcoin charts. It's not recorded. And also for the gift, fake gift, I don't think we actually distribute the gift accordingly. Just make sure that you have enough trading volume, and also spend your crystal in the candy drop event, and we will have the candy drop within 12 hours. We'll distribute the airdrop to your account. So don't worry about that. All right, Dave, sorry to disturb you. Let's continue about the tokenomics analysis.
No worries, bro. So
Yeah.
we are also going to talk about vesting period, like how many tokens or how many percentage of tokens are being vested to contribute to the net inflation rate, and also the total supply to circulating supply ratio. So we always analyze the token with the the circulating supply divided by the total amount of tokens with the max supply or total supply, so that we are going to know that how much or how many percentage of the tokens that are going to be vested from the vesting pool. That's basically the lock supply. So if the ratio of the lock supply to total circulating supply is high, it means that more tokens are going to be vested and more introduction to like inflation and a lot of low resting supply. So we are going to see a good tokenomic design that has high circulating supply over total circulating supply, but it's just like an edge. So that the six point is probably the inflation rate with the aggressive inflation and aggressive resting. Like if there is sort of like if there's anything not any moment that or any day in the time range that we're going to see a aggressive vesting, like 10% or 30% of the total supply is being vested over 2 days or a week or so. So this is very important. If there's so much supply happening within weeks or days, we're going to see a lot of sell pressure, probably or probability, so we also have the utility and demand, like the use cases or like the utilities or application of tokens, like if we can stick tokens or can we burn tokens with some utilities? Should we lock it for interoperable chains or interoperability with bridges and stuff? We also have like proof of authority. We can stick our tokens. We have also like the graph protocol indexes and also a lot of applicants and application users. They also have to pay in their payment system and stick it, and also sort of like in the protocol we also have to burn it to apply to tokens as a utility. And also the ecosystem of developers abilities that if we can see that more developers or more ecosystem participants are going to use a token, like for example, Arif. So in Arif chain, we tend to use Arif token as a payment system, token for storage. So if more protocols are going to be developed on top, they're going to pay more Arif token to the storage chain. Then we have more utilities and more ecosystem application with the AR token. So let's jump on to solve like the fundamental of tokenomic analysis on the first protocol, Solana. So Solana has a great solution, I guess. It's like it has a proof of history and how a BFT that's basically is how the validators are sizing and ordering their blocks, writing their blocks in the chain in a chronological order with time. It's called proof of history. But sort of like it has a product solution of some kind of fair, comparatively to other blockchain protocols, because it's like fail for some time because of the DOS and overload the bars, and also with its relatively a weaker, can I say that? Maybe it's like a weaker tokenomic design that it doesn't have a max supply. It doesn't have a cap supply. So basically, what it means that token can be inflated, forever or all along the way. So to control the inflation rate, we need to see how in the protocol, tokenomics are designed. Like for example, if like 60%, let's just say if like sort of like 60% of the validators are validating, or the 60% of the total tokens are being locked by the validators. So we're going to have a design of 2.5% of inflation rate. That's great. So because it can reduce the circulating supply and reduce selling pressure, and increase the demand for staking, and also reduce the inflation rate by incentivizing more tokens being staked. For example, if like only 30% of the total Solana tokens are being locked up, let's just say we have sort of like a 60%, or I'm just saying like if 40% of the Solana tokens are being locked by the validators, we tend to see like 4.5% or 6.5% of the let's say it's just a percentage of the inflation rate. So we tend to see that if we have more tokens being staked and locked up, we're going to see a lower inflation rate, although there is no max supply and no limited supply or cap supply of total tokens. So probably Solana doesn't have a max supply. That means it has a more side on the supply side, but they also have the token utility of being staked and also locked up to control the inflation rate. So what do you think about Solana and also the tokens, Johnny?
Yeah. I'm thinking that we can actually do a analysis on what you just mentioned, the current price relative to the circulating supply and also fully diluted market cap. And actually, we can also plot a chart here to see the ratio so that we see how the price relative to circulating supplies is going. And right now, the circulating supply is standing at actually it's like about 300 something billion. And right now, the Solana price is trading at 44. And if Solana has a larger lockup supply, I mean, we are going to see some downward selling pressure in the future, right? So why not let's look into the supply picture, right? We can see that how tokens are being locked up here, and also the token distribution. So maybe Dave, you can let's tell me and also tell the audience how to look at the chart, the takeaways.
Cool. So there's like a Western schedule that is pictured being pictured like what we're seeing right now on screen, like with it blue and red color, orange, also yellow color, and these are also symbolizing the part of this tokens or the percentage of the tokens who are are they belonging to the founders, the grand pools, the community reserve that's locked for community, and Solana Foundation for development, and the seed sales to our investors, and the funding sale for the funding team and funding seed round investor. That basically very early for investor or investment people stuff. Validated sell and selling to the validators and launch sell also to the investors and public auctions and stuff. So right now we're seeing that there is increasing supply or increasing rate of change of supply or the increasing change of supply that the Solana tokens are inflating all along the way. So we also have to think about what is the net inflation rate. Like for example, if we roughly calculate for from January to 2022, so we have tendency to have like a 500 million, and after January 2022 26, we have to see a 615 million total tokens after vesting period of like 4 years. So probably we're going to see like what was that calculated? It's like 200 million, right? 200 million, over like 4 years, right? So probably we have like 50 million of tokens, being vested or being inflated to the whole market. So we have to divide from the roughly divided from the initial supply relatively if we compare it on from the January 2022, so we divide 50 by sort of like 500 million, so probably we are going to see a 10% inflation rate for the four coming years. But if we see that closely, that at some point of time, I'm not sure about that, but according to Masai research, we're going to see quite some time before January 2022, we can see a aggressive supply or aggressive vesting of the Solana tokens that is basically from 0 to like 500, something stuff. So it's very aggressive, like aggressive vesting or aggressive inflation rate that we traders or investors have to consider about it. So not investment advice, but we have to use this scenario, this perspective, like initial supply, max supply, vesting schedule, aggressive inflation, steady inflation rate, to understand that if we are going to buy or sell a token based on these factors that are going to affect to the sort of selling and buying elements on the market. So what do you think about this sort of like analysis and also the supply schedule, Johnny?
Yeah, we're seeing that the supply is going to increase, right? We are seeing the supply is increasing from January 2022. It's many comes from the public auction, right? So people who invested in the public auction, they sell their tokens after that, after they unlock their tokens. They probably acquire the tokens at a cheaper price, and then let's see, because if their holdings are being unlocked, and then that means that they can dump their tokens, right? And more supply is not we want to see in a tokenomics, right? Because we want to have decreasing supply, or just like Bitcoin, a fixed supply 21 million, and some deflationary coins, for example, like some other meme coins that have a burn function, which burn some token from every transaction. And because a deflationary supply is going to squeeze the supply, right? With less supply, we're anticipating the price is going to increase, right? Assume that demand is constant, or that demand is increasing. That's really important. So so how now we're going to expect that more supply is coming in, the price is going to, have some negative effect because more supply, right? But let's see how it plays out, because if Solana turns out to be more to have more utilities and more functional, to be more less errors and less mistakes they made in the team, and then with more demand and good marketing, maybe the demand stepping in will consume the supply. Who knows, right? Yeah. So that's what I think.
Absolutely,
Yeah.
absolutely, absolutely. So let's jump to like the tokenomic analysis of
Yeah.
KuCoin token.
Coupon
In
token.
this case, yes, so probably this is like our competitor, the KuCoin exchange. So we have no in this weekly market chat, we don't have a business or collaboration relationship with KuCoin exchange, but we still have to analyze, as an example on tokenomics of another, token from another exchange. So quite pretty great. So if we go to CoinMarketCap or CoinGecko, probably people will miss there's some cheeky data from the CoinMarketCap. So CoinMarketCap and CoinGecko are pretty great, in terms of providing the information on the tokenomic analysis, like market capitalization, fully market capitalization, so that we can sort of have like comparative, the relative valuation, like certain supply, the volume change, and also most importantly, we have the max supply data of token and all those total supply of the total token. So we are seeing that the KuCoin token is having a max supply of 170 million, and we have like a total supply right now, probably a certain supply and stuff for like 145 million on the total certain stuff and supply. So in this token, we tend to see a limited supply side with a demand side of the token. So we also tend to see a total supply of 145 million. So the total supply is 170. So if we divide it by that, we tend to see a 85%, of the total supply being on circulation, or the total supply. That's basically, it means that 85% of the tokens, if that data is interpreted true, so 85% of the tokens are now on the market ready. So there is only like 15%, 15% of tokens that are going to be locked up until they are released and passed on to their lock period, that some investors may be going to sell it. Sort of the stuff. So we tend to see a relatively healthier certain supply to max supply ratio, or a total certain supply to a max supply ratio. So pretty awesome. So if we jump to the tokenomic analysis of the curve, so we tend to see there's a blue, there's a green, there's a pink and purple, and yellow color indicated for the tokenomic supply in resting schedule. So we have like token burn, there's basically the demand for the token. Early investors, some portion of that, but that's relatively small to ICO. So we also have founders, and also the ICO, big proportion of the total KCN, token design. So in this chart, we probably see that on the supply curve, we tend to see there is a max supply along the way, since the probably January 2022. This is basically great. It means that in January 2022, we basically already have the max supply rate, and there's a little bit of resting or no resting, according to sorry research. We also have a steady inflation from after the ICO from 2018 to 2022, and also sort of like deflationary design with token burn. So how do they burn their own tokens? Basically, they exchange, they use their exchange revenues to buy back on their market share in order to reduce supply and increase the demand for the token to destroy or to burn the token itself and destroy from the total circulating market capitalization. So this is great for demanding tokens, right? And also, we tend to see a sort of like a great initial supply to final maximum supply. That this figure doesn't vary a lot, So probably I'm analyzing a relatively balanced tokenomics with great design, great demand, and also probably limited supply side and with a great utility. That means burning the revenue of the exchange onto the token total supply. So what do you think about that, Johnny?
Yeah, and we can actually compare, sorry, here. We can actually see that the maximum supply of KuCoin, as you mentioned, that is standing at 170 million. Then, and actually, we can also we can see that the price trading at 10, and maybe we can compare with other exchange platform tokens to see that what's the ratio between the price and to the maximum supply. So I think basically in a bull market, I think exchange tokens are gems because they actually have real business to do, right? They take transaction fees, and also they earn from future trading. They sometimes get paid a lot from liquidations, and then at the fundamental and we can see that actually you just mentioned that 145 million is now the currently circulating supply, and that's almost like 80 something percent, and then with 10 more and 20% of supply being unlocked in future, and that's, I think, it's a steady inflation, and that's okay. I think that's my opinion. Yeah.
Great. So the third protocol that we are going to share our views on tokenomic design is probably Cosmos. So Cosmos is basically selling its protocol or solution or dream that it has the properly to be interoperable with other chains with the inter IBC relay chain and bridge stuff with the recently launched the Gravity Bridge and Gravity DEX and stuff. So ETH mouse and stuff, they're all validating with the Cosmos interoperable zone. So we are going to when we go to the CoinMarketCap website, we're going to see a starting supply of 286 million of starting supply, but there's no total supply. So probably we're going to see if there's a more utility on the Cosmos token. So if we see we are going to analyze the sort of like the total circulating supply or the utility of the token, we tend to have to understand if there is a good utility related to the Cosmos or to the protocol itself. So this protocol is called Cosmos, the interoperability chain. Is also going to launch its Autumn 2.0 or Cosmos 2.0 white paper. So stay tuned for the whole ecosystem. Basically, for the according to the Masara research, we are going to see a chart that it has a red and a pink stuff color. So we have block rewards and strategy and early adopters for the investors, private contributors and public contributors, AIBC, the interoperable chain, and ICF, the interchain foundation. So basically, we see some factors that are affecting, with the symbolizing, or they are symbolizing the steady inflation rate of the Cosmos ecosystem. So we also tend to see a utility of the ARM token that's basically staked, dedicated proof of stake system that's basically called the staking your tokens into the validators that can get their stakes and to validate for the whole Cosmos chains. And also if there is sort of like malicious activities happening onto the validators, they get slashed with reference to their downtime and also with the reference to the sort of like downtime and also the number of transactions that they are wrongly validating. So if you're delegating your tokens, we tend to see a risk of malicious activities and the tokens being slashed, that's burned permanently. So with these two utilities, I probably see a general or a normal level of utility or more normal level of utility demand for the basically the token. So with this sort of like weak, relatively weak utility on the Cosmos token, we tend to see a less demand side and a unlimited supply side. So probably we are going to have to see if there's any sort of upgrade or improvement on the Cosmos token. Although I really believe in this solution is an interoperable chain with other chains that being a multi-chain environment and other than the cross chain. So basically, multi-chain is like is a hub to bridge a lot of chains together, and they are validating the transaction on a multi-chain level across chain, like in a multi-chain, different chain environment, like Solana, the Cosmos validating with if the Cosmos stuff or in the same environment. But if we are talking about crossing is just between one and the other bridge. For example, if you are the validator, you are just validating only if there's a Cosmos to Solana bridge, or let's just say a Solana to ETH chain. There's just only one to one crossing partner. So basically, Cosmos is a great multi-chain protocol that I will believe in, but in my own perspective, no investment advice, I think it's better to enhance the utility of the ARM token. So let's jump to if there's sort of like any upgrade, that's going to bring awesome awesome news to the audience that if there is a sort of an upgrade to the recent protocol. So last weekly market chat, we shared our views on the free vote tokens that we have the perpetual protocol. We also the token holders that we tend to have to see more lock supply or more locking schedule for the token holders that more locking reduce supply, more locking increased demand for governance and avoid some whales or some people just maliciously or just intentionally just vote and for more of their token reward, and they get voted and pass their proposal and dump the tokens and create selling pressure and short the tokens stuff. So for this upgrade, I think it's going to reduce the downside of the pump and dump or just vote to dump effect of the token. So what do you think about sort of like the utility and stuff for the tokens, Johnny?
Yeah, it's good to see that the protocols are having upgrades, because the reason why they have upgrades is probably because they are having some organic development, right? Because they have active users, they have real business doing, and they want to improve their models, and They just want to make improvements. That's why they have upgrade. And upgrade is great for a lot of projects because with upgrade, they make improvements. After they make improvements, and then users are getting benefited from the upgrade, right? Because things are going to become better with the upgrade. For example, for the V token, and we are seeing that the upgrade actually grants users some voting power. So holding V token, and they can actually vote on the projects and also vote for future upgrades. And that's what we want to see in a really community-driven model, a community-driven project here, because community members are very important, because without community members, without supporters, and the project will be useless, right? Because the project fundamentally we need real users, and also we need active users. So that's why upgrades are good for a lot of projects. Yeah. So here, yeah. So probably Dave, let's talk about this thing, the V tokenomics, and also the curve and the reduced circulating supply. It's a little bit complicated here on the chart. Probably you can illustrate how to read the chart here.
Yeah, so I think it's quite complicated, quite hard for people to reveal. But I'm going to break it down with some simple factors. Just forget about the chart. Just look at the left down side of or left down corner of the the screen. So Tennessee have a CRV release over lock CRV. So if more tokens are being locked, with the CRV vote, token design, that's basically what does it mean? It means that if you have to vote, you gotta lock your CRV. That's simple. That you can vote and lock your CRV, then you finish the proposal, you get a CRV back, dump on the market, you can't do it. So right now we're going to incentivize voting with more locked tokens on the market. Then in the total CRV, the locked CRV is going to increase. So the CRV raise is over locked CRV in ratio or the factor. I mean the CRV being vested over the total locked number of CRV is going down. So it means the total supply or the total demand on the market on CRV token is going to increase. So this is beneficial to the whole CRV token ecosystem. So this is what I want to tell people about the upgrade or the tokenomic 2.0 stuff for the our audience. So basically, if we break down the chart, we're going to have see the CRV token, the voting, the escrow, and we have the insurance gauge, liquidity gauge, liquidity gauge 2.0, and into the gauge controller. That we also have the contract registry that basically say that to vote a token we first have to go to the voting escrow, then we have contract registry, and also the gauge controller and stuff. But it means that with more voting locked up, that's the key point, that it's going to reduce the net supply and increase the net demand for the tokenomic upgrade. So what do you think about that, Johnny?
Yeah, the chart is looking a little bit complicated, but you just broke it down clearly that we can look at the full locked CRV and also the CRV to determine the future supply of this thing. So basically, we're seeing a reduced circulating supply, right? And that's actually kind of beneficial to the project, because reduced supplies is going to mean that the price is getting less dumped, and that's what I can conclude from this thing. So maybe we can look at the next upgrade of another important protocol, the Pancake Swap. Yeah, what's your view on this one, Dave?
So Pancake Swap is also a on BSC chain. So basically, it's having a max supply of 715 million, and also total supply selling supply of 319 million on the total tokenomic design. So probably we tend to see a 50 less than 50% of the ratio between the circulating total supply over the max supply. So if we're going to see that this ratio, we probably seeing more than 50% of the tokens are going to be vested on the market. So probably we tend to see that there is a mass amount of the tokens being vested or inflated on the market. Not a very great point to notice on the tokenomic design. That's the key takeaway to the our audience. Because you also tend to see, let's jump on to the the upgrade of the recent protocols that we also have the utility on the kick token. So we have the free kick upgrade that's boosted for governance voting. So we have also the iKick, that's the boosted IFO benefits. That means the benefit of the iKick token on our IFO activities. And we also have the boosted farm benefits with the B kick. So with these derivatives on the cake as quite derivative, so we tend to see a selling pressure of the free derivatives instead of the selling the token itself. So that's I think to my mind is a great thing, because like if you can sell derivatives rather than selling the key or the original token. That's basically a sort of reduced selling pressure. But we also have to sort of know or analyze the ratio of the market of these derivatives. So like if there's sort of like any sort of like the correlation or the picking of the tokens, like previously we tend to see a depicking of the SDETH, that's basically Lido-stick ETH, and also the sort of like the Lido-stick ETH, and also the ETH token itself correlates with the or the picked with sort of like 5% to 10% ratio. That's probably not a great thing. So if you're trading with these tokens, you're probably going to have to analyze the risk. And also, maybe there's a chance that we can also arbitrage with these tokens. If we are seeing catalysts coming, for example, we can trade the stake ETH, buy stake ETH, derivatives, since it's also discounted over in the ETH, and trade over or sell it when there is a great event like ETH 2.0 merge. So this is probably what I can think of on the risk management of the derivatives or tokenomic update. So what do you think about tokenomic updates and tokenomic design and kicking stuff, Johnny?
Yeah, actually, yeah. So I want to talk about tokenomics of the meme coins, because meme coins are very funny. Some meme coins, very popular meme coins like Dogecoin, Shiba Inu, Doge from Mars, baby Dogecoins. There are also some derivatives of it's just some variations of Dogecoin. So what they do is just mirror Dogecoin, and they acquire some community members, and meme coin actually becomes a community driven coin, and also they have that very interesting culture there. They also have what they say is a store value, just like what Bitcoin does, and what they do is they acquire they acquire as many as supporters as they can, and they grow the community, and the meme coin grows accordingly. And meme coins usually have a large supply, and that's why their coins are very cheap. Yeah, just look at baby Dogecoin. I don't know how to say it. Wow, 0.000000163. That's really cheap. You can actually buy a bunch of baby Dogecoin. That's really fun. Yeah. Actually, they are also the coins that explode and go to the moon in a bull race market. Right, Dave? What do you think? Meme coins.
Yeah, so we also have like something like Moonbird, Shiba, a lot of meme coins, and we also trade it very well. But so I think traders have to understand that if we are going to have a bear market and it's going to drop to zero, I'm sorry to tell you the truth, but But this is proof that we have to understand the risk of the trading meme coins and stuff. So I like Doge, I like animals and I love them, but we have to understand the underlying risk of the investment tool. Right, Johnny?
Yeah. Meme coins usually have a higher volatility. So in bear market, they tend to fall. The prices of meme coins are tend to drop more than other coins with utility and also functions. So higher volatility, just like Shiba Inu and Dogecoin, they just rose 22.5 and 34.17% in the last 7 days. Quite impressive, right? In the recent market, we don't see a lot of upward movement, but meme coins usually have surprises. Yeah. So let's go to Candy Drop. So a lot of you guys are commenting in the comment section that we don't distribute tokens, but actually we do. So this time, in order to participate in the Candy Drop event, you can either have 1,000 USD trading volume in spot account, or you spend 30 crystals to join the Candy Drop event. So the two methods, the two methods will have different tokens to be distributed. So make sure you look at the Huobi app, and also when you participate, you look at the instruction there to see what coins do you want to receive, and then you choose the participation method accordingly. So make sure you have enough trading volume at Huobi app, and also try to earn more crystals so you can join the Candy Drop event next time maybe. And also the tokens will be delivered within 12 hours. So make sure you check your account, and also we also select one lucky star. The lucky star will get 1,000 USDT, and that's really impressive, right? So make sure you participate in the Candy Drop event, and the lucky star will be notified via SMS. So that's all for the Candy Drop event, and see you next time. Next episode, we'll have more interesting topics and also exciting things to talk about. So make sure you stay tuned, and we'll see you next week, next Wednesday, right, Dave?
Cool. Let's see you around.
Yeah, peace. Bye. Thank you for listening.